Welcome to BG Consulting eLearning's series on interest rate swaps. This module is an introduction to interest rate swaps. A swap is a contract between two parties to exchange a series of cash flows. One party pays a series of fixed cash flows defined by a fixed rate applied to the notional, while the other pays a series of floating payments generated by applying a specified variable rate, normally the interbank borrowing rate, so-called LIBOR or Euribor, to the notional. An interest rate swap is defined by four key numbers: the notional, the maturity, the fixed rate, and the tenor of the floating rate index. In the example on this slide, we have a 5-year, €100 million swap in which one party pays 4.8% every year, that's €4.8 million in cash every 12 months, versus receiving 6-month Euribor, set at the start of each period and paid in arrears. The cash flows are shown schematically on the next slide. These cash flows are shown from the perspective of the receiver of the fixed leg, or conversely the payer of the floating leg. In this example, the dealer receives 5 fixed rate payments over the life and pays 10 semi-annual floating rate payments. All the cash flows are computed as notional multiplied by the rate multiplied by the day count fraction. The latter is necessary because the rate is always an annualized number, but in this case the period is only half a year. We show explicitly the calculation for one particular period. The payment at the end equals the Euribor fixing, which is set at the start, multiplied by the notional, multiplied by the day count fraction, which in this case is 182 days divided by 360. The calculation of the day count fraction depends on the currency concerned and also depends on whether we are computing fixed or floating rate payments. A summary of the most commonly occurring day count conventions is shown here. For any specified maturity, there is a unique fixed rate for which the swap has net present value equals 0, i.e. the swap is fairly priced for both parties. This unique fixed rate is called the par swap rate. A list of par rates by maturity defines the swap's yield curve. On the screen here is the euro yield curve. To understand what it represents, take for example the 10-year quote, 1.954% at 1.994%. The lower number is called the bid and represents the fixed rate that a market maker would pay to a customer against receiving 6-month Euribor. The higher number is called the offer or the ask and is where a dealer would receive fixed rate from a customer. As with any market, the dealer always trades at the most advantageous price for him. The midpoint between the bid and the offer, in this case 1.974%, is called the mid-market rate. At this rate, the swap has a theoretical PV of 0. The difference between the dealing price and the mid-market rate represents the dealer's theoretical P&L on the trade. So for example, if a dealer pays fixed at 1.954% on a 10-year swap, he is paying 2 basis points below the fair rate, and therefore his P&L is the present value of 2 basis points per annum discounted over the life. How to do this calculation precisely will be the subject of Module 3 in this series. The fact that the swap has PV 0 at the par rate leads us to a very helpful and intuitive picture of what the par rate represents. If the swap is fairly valued to both parties, then the value of the floating leg must equal the value of the fixed leg. And therefore, the fixed rate must represent the market's expectation of what Euribor is going to average over the life of the swap. The graph on this slide shows the euro par curve, in orange, out to 10 years, and the implied forward curve for 6-month Euribor for the same 10 years. The 10-year par rate of 1.974 does indeed look like the average of Euribor over the life. Swaps are not the only way of trading interest rates. Traditionally, that would have been done by buying or selling government bonds. From a market risk perspective, and ignoring issues such as funding and credit risk, there is essentially no difference between a swap position and a bond position. If the notional amounts are equal, then receiving fixed on a swap is economically equivalent to owning bonds. The position makes money when rates fall, i.e. it's a long position in market terminology. Similarly, paying fixed is equivalent to being short bonds. In summary, a swap behaves like a synthetic, unfunded bond. In the US dollar market in particular, and to a lesser extent in some other currencies, there is an alternative way of quoting the swap rate. Instead of quoting the par rate as an absolute number, it is quoted as a spread over the US Treasury curve. So for example, looking at the right-hand side of this slide, we see that the two-way price for 5-year swaps is 11.25 at 14.25, which we read as being the number of basis points for the swap over the yield on the benchmark 5-year Treasury. The absolute rate, computed by adding back in the Treasury yield, is displayed for convenience on the left. Swap spreads are quite volatile and carry information about the state of the economy. Because a swap rate represents expectations of interbank borrowing costs, the spread over government borrowing rates is a reflection of the creditworthiness of the banking sector. So we see on this chart that the spread blew out during the banking crisis in 2007-2008, and again during the Eurozone crisis of 2011 and 12, on concerns about bank defaults. However, the overall trend over the last decade has been for the spread to narrow, as collateralization and other credit risk mitigation techniques have become more widely adopted.